silver would be the fuse on gold. And it's looking pretty squeezy right now. When I say squeezy, from the short squeeze standpoint, we've been in a supply deficit for 5 years. And that's only broadening. It's not coming back to balance. And the only thing really that can balance the supply deficit out are higher prices. Now, the problem in the metals industry is that the supply chain is relatively inelastic time-wise to price. You could discover gold or discover silver today, hit the mother lode, but you won't be in production for 7, 8, 10 years, just because you've got to build out the infrastructure, you've got to get all the permitting, et cetera, et cetera. So it's an unusual market compared to, say soybeans or whatever. You just plant more for that year to make up for a deficit. You can't do that with silver. And I think ultimately, silver is going to fail to deliver. In my eyes, that's within the next few delivery periods. So I think before year end, you're going to see the silver market break. That will immediately spill over to gold. And the problem with the gold market breaking, when I say break, I'm talking about contracts basically going to zero and physical being not obtainable. The problem with that is gold is a thermometer, barometer, whatever you want to call it. Much, much higher prices means that confidence has or is breaking. And the entire Western world's financial system runs on confidence. Right, an ounce 100 years ago of gold or an ounce today or an ounce 100 years from now is still just an ounce of gold. It doesn't change at all. The only thing that changes is the measuring stick, and that measuring stick are currencies. And currencies worldwide are going down because gold has broken a new highs in all currencies. Matter of fact, the dollar from $35 in 1971 to $3,500 plus now, that's over a 99% drop in purchasing power. And that's happening with other currencies. And we can talk about yields, if you'd like, sovereign yields, because they're going higher worldwide. And that's the real tell as to what's happening. Well, yields across the board, sovereign yields, are defying, if you will, what the central banks are trying to do. The central banks have started to cut. We're going to probably get an interest rate, a Fed rate cut this month in September. Go back a year ago, the Fed made, 3 cuts totaling 1%. So short-term rates dropped 1%. But while that was happening, long-term yields rose by 1%. So I think the danger with this September rate cut is that they cut rates and we get a sell-off in bonds. Now, that said, that would show the Fed losing control of the yield curve. And that's important because obviously, it's the biggest market, and all financial markets are based by a foundation of paper, of U.S. Treasuries. Now, that said, I think the most important yields to watch are the Japanese 10 and the Japanese 30-year bonds. And the reason they're important is because for years and years and years, when Japan was zeroed out as far as interest rates, the yen carry trade is a huge factor in blowing this bubble to where we've gotten to. And a stronger yen and higher interest rates or lower bond prices, what that does is that's going to unwind the carry trade. So for years and years and years, leverage was put on the long side. And with these much higher yields and a stronger yen, that carry trade is being forced via margin calls to unwind. And when you get something of the size of the carry trade unwinding, it cannot ultimately be a slow conservative drop. I mean, this is going to be, it'll be some wild times. Well, 5% was the high. We're 4.25 thereabouts now on the 10-year, but that was the high on the move, up from, well, I mean, at one point in time, I think the 10-year traded as low as 0.6 of 1%, or maybe even lower. So it's been a huge move already. And, I don't know if 5% is the number or not, but there is a number that unwinds the entire credit edifice. Because what you need to understand is that the entire world, whether it be financial markets or the real economy, everything runs on credit. And if credit becomes more expensive because it is being shunned by foreigners, how does the U.S. How does the U.S. fund a $2 trillion deficit? That's an extra $2 trillion every year that they have to borrow. And the answer ultimately is the Federal Reserve will buy those bonds, but that is, outright and direct monetization. The problem that the West is in right now is it's a debt trap. I mean, in the U.S., we're paying $1.5 trillion in interest alone. You've got problems in France. You've got problems all over the world with sovereign debt. There's too much of it. How do you service it? That's why they're desperate to get yields down, but Mother Nature, market, is pushing rates higher. And that's where rates should go, because there's more and more risk. There's little to no risk premium in sovereign bond yields across the globe. The obvious hedge is gold and silver, and the reason being gold nor silver can bankrupt. They are money themselves. They cannot bankrupt in a world that is bankrupting. Yeah, I think your comment, the gloves are off, I think that's up until this point. I mean, it would be extremely easy to break the Western financial system with $5 or $10 billion. I mean, if you went into COMEX and LBMA and said, here's $10 billion, I want metal, it'd be over. There's no way to deliver that kind of metal short term. So it would break the markets. In the past, I want to say that Russia, China, the rest of the world were being polite because they didn't want bombs raining down on them. One of the big things, the reason the dollar has been the reserve currency for so long is the U.S. military. Basically, we forced the world with threat of the U.S. military. If you don't use dollars, I mean, look at Saddam Hussein. Look at Gaddafi. They both talked about, 15, 20 years ago about doing a gold-backed currency, and what happened? They were killed. In the past, countries have seen, those two examples, Gaddafi and Saddam Hussein. They saw those examples and said, well, yeah, we'll just buy it quietly. And now that the war of words is on, it would not surprise me to see either a country or countries together step up. And the Achilles heel to the Western system is the fractional reserve nature of the entire system. But the way to expose that is just create a failure to deliver in either silver or gold, and it'll be both within 24 hours. If either goes, the other's going to go within virtually immediately. So they're at the point now, like you said, the gloves are off, and money is just flowing into, whether it be the physical metal itself or even the leveraged contracts in the West. You're seeing foreign nations buy those. The much higher price, I made the comment before we started recording, be careful what you wish for.
Yes, yes.
When we go through $50, and that's if markets stay open. I mean, there could be a failure to deliver, this month. I mean, who knows? But once we get through $50, you've got people talking $100, $200, $600 silver. There's really, in today's world, there is no way to project a number that gold or silver can go to. Um, and I mean, the reason being, the parameters are zero and infinity. And the reason infinity is a parameter is because if a currency goes to zero, then it is priced at infinity in that currency. In other words, no amount of currency can buy an ounce of gold. That currency won't be accepted. And that's where we're headed on a global basis. I mean, if you think that the US dollar can collapse, crack up, and the system remain running, that's not going to happen. It can't happen.